Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I will be taking a look at Hormel Foods. These guys just had their investor day last week. Stock market did not love it, down about 9%. Could be a combination of that, plus the fact that they just ratified a new union contract with $3 to $6 per hour raises for their employees, which again could be a good thing. I always love it when companies reward their employees, could help productivity, and capitalism has to work both ways. At the end of the day, though, the stock itself is down 30% in the last year. Even if you go 5 years out, it's still a very negative return. You really have to go 10 years out for this to be a good investment for investors. And do note that I do own Hormel Foods in my Dividend Aristocrats portfolio, but it is a very small position. And being a Dividend Aristocrat is why this stock probably has performed as poorly as it has, on top of the lack of growth. Really, people bid these stocks up quite a bit as an alternative to fixed income when bonds were paying 1 to 2% or lower. Suddenly, a 3 to 4% dividend really looked appealing, especially when it has grown and increased for 57 years. So, you looked at these companies, they had 2 to 3% free cash flow yields, which is really, really low for something like this, for something not growing at all. And that's why it's dropped as much as it has, on top of the lack of results, really, in a lot of these scenarios. We looked at a couple of these companies that have been hit in the last couple of weeks, and I do want to set some price targets for them because they are starting to get close to being interesting or interesting, depending on the company. And this company makes meat adjacent products, protein adjacent products, spam, holy guacamole, Planters, Skippy. They just acquired Planters not too long ago, but most of their business is retail, some food service, and some international. And really, the problem here has been that they haven't grown. In 2016, they had 1.31 billion in operating income. That dropped until 2021 and then ticked up in 2022 back to 1.31 billion in operating income. And that's not very impressive when you consider this was a company that was being given a 30x free cash flow multiple, basically, just a couple of years ago, maybe even a couple of months ago. And that's clearly what's driving some of the repricing that we're seeing today in a lot of these stocks, because you're not getting any operating income improvements, you're not getting any bottom line improvements. So why is the stock getting such a multiple? And it's really because the dividend was so appealing. This is a consistent dividend payer, dividend raiser. And now that interest rates on bonds are 5 to 5.5%, 3.5% just does not look that appealing. They've divested some assets that were lower operating margin assets. They've added some assets that were higher operating margin assets with better net sales. But at the end of the day, they're still seeing margin pressure on the bottom line due to their cost structure, and that's certainly going to continue with this new union contract. They're going to have to raise prices, but how much of that is going to impact their volume? You have the other side of things in that you've got all of these new drugs, Wegovy, Ozempic, whatever, that are amazing apparently, and all of these stocks are being impacted by that, as well as people think that if people start losing weight, if a lot more people go on these drugs, they're going to eat less and less product, and that is going to impact companies like Hormel, which makes meat. They've got all these initiatives. If you look at these investor presentations for a lot of these food companies, they've got some sort of initiative. In this case, is the Go Forward initiative to make them better, to make them more efficient. But do they really work? At the end of the day, they say they're a new, more efficient company, but in 2016, they had 1.3 billion in operating income. In 2022, they have 1.3 billion operating income. Seems like they're exactly the same. Nothing's really changed, and they do have a 3-year plan to change that, and that's what they announced during this investor day. And why the company was probably not rewarded as much as they think they should be. It's really only $250 million in operating income growth by fiscal 2026, and that's okay. But if you assume that's off of a base in 2022, which is what they're starting with here, it's only about a 4% growth on the operating income side per year. So not that impressive. On top of that, it's operating income, so it's not all bottom line income. There's going to be taxes on that, and they're probably going to have more interest payments since their interest is going to go up as they have to refinance some of their debt, which means that their bottom line is probably going to grow at a slower rate. So they have this path, you can kind of look into it more, but at the end of the day, it's like, how do we improve our cost structure? How do we improve our bottom line by driving modernization, transformation, and essentially efficiency in the way we go from input to output, the way we go from raw material, whatever, pork or whatever they're doing, to the sausage that they're selling and delivering on store shelves. And that's kind of the idea here, whether it's synergies from M&A, whether it's this go forward initiative that hasn't yielded much, but they probably started not too long ago, whether it's improvements on the supply chain, etc. That's what they're looking for to improve their financials. And their financials have been, right? At the end of the day, if you look at their estimates, go back to, let's say, 2016. Yes, there's been some growth on the revenue side. Some of this has been through acquisitions. They acquired Planters around here, so obviously some good growth here, but that's mainly due to acquisition. Before that, if you look at organic growth, this is a company that got 0 to 3% organic growth per year on the revenue side. But more importantly, since that acquisition, since the pandemic, they've had some pressure on their margins, their EBITDA margins down about 3%. So even though the revenue has grown by 2 billion, not much of that has flown down to the net income, only a little bit. And they haven't been buying back shares, which is weird for a company like this. So the share count has actually increased. So if you look at, hey, in 2016, the earnings per share was 164. Now it's 182. So some growth, but not a lot. And now in 2023, it's expected to shrink back down to 164. So really almost no growth between 2016 and 2022, despite top line growth. Not a lot of that is going down to the bottom line. And that's consistent with some of these food companies. You've got inflation putting pressure on their input costs. They can't pass all of that through to the customer, so their margins get squeezed and they have to change that. How will they be able to change that? Some of it will be improvements on the cost side, but also probably higher prices. And the question is, do those higher prices impact volume? Do these new drugs impact how much stuff they're actually able to sell? Do people start eating meat less? Yada, yada, yada. All of that good stuff that you have to consider when you're investing in a company like this. They are a free cash flow machine. The nice thing about this is if you look at 2008, continued to make money, continued to be positive on EPS, free cash flow, continued to grow their dividend. So if there is a recession, are people still going to eat? Yes. Will their costs, will their revenue and bottom line be cut a little bit? Yes. But that's why this stock has always gotten a premium, because it's relatively safe and people like it. However, maybe the premium it had the last couple of years was a bit too much, and now it's kind of reverting back to the mean. Before we go into the financials and my valuation sheet, please note this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Do your own due diligence. And as always, if you like these videos, like down below, leave a comment down below, and subscribe to the channel. And hello to all of my new subscribers that have joined the channel in the last couple of weeks as I make more and more of these videos. So looking at the stock ticker, 17.2 billion market cap at today's price of 31.63. I'm going to hard code this because it's going to update because the market is live right now. 2.6 billion in debt, net debt, leads to an enterprise value of about 19.9 billion. The market is giving it about a 5% free cash flow yield right now, which seems about right. One thing to note is they have not been buying back shares in the last couple of years. They did in 19, but in 20, 21, and 22 actually issued more shares for whatever reason, whether it's stock compensation and or just issuing shares for acquisitions, etc. But this has led to share count growth since 2016, which is not that common with a lot of these dividend payers. As they do generate free cash flow, you'd think they'd be buying back some shares, but they are not. They do issue a dividend that is consistent. I'm going to assume it's growing at 4%. That's kind of what it's grown in the last year or two. Maybe a bit higher if you think about their free cash flow payout ratio. It's in that 75% range, so about right. They have some wiggle room if the free cash flow gets hit a little bit. So the dividend seems pretty safe, and like I said, they've paid it and increased it for 57 consecutive years, which is pretty impressive. On my revenue growth assumptions, I'm being a bit more conservative versus the estimates that ticker shows. Slight decrease in 2023, but then about 2% growth going forward. And then my assumption is kind of going off of what they gave a target for in their investor presentation. They're going to hit about 7.8% in free cash flow margin by 2026. This is kind of an assumption off of their 250 operating income, what they're going to have to pay in income tax off of that, what they're going to have to pay in interest payments off of that. To get to a net income, to get to a free cash flow, etc. And then slight growth into 2027 as well. Kind of the idea is they used to have margins that were as high as 9%. I'm kind of getting there by 2027. Most of their money, most of this 4.8 billion in free cash flow is going to dividends, but they do have about 1.5 billion in excess free cash flow. I am assuming a buyback of about 10%, about 475 million. But like I said, maybe that's a bit optimistic given what they've done in the past couple of years. Maybe they won't buy back any or even issue more shares based on stock-based compensation, etc. So that could impact returns because that is about a 50 to 100 basis point return depending on the yield that you're getting. Right now, the market's giving it a 5% free cash flow yield. I'm going to assume 60% in that yield. 30% of my scenario will go to 6%, and 10% will go to a 4% free cash flow yield. So some upside if it goes to 4%, some downside if it goes to 6%. And I think it's more likely that there's downside versus upside. Given all of that, the weighted return on today's price is about 7.9%. So not terrible, but not exactly amazing. Why not just invest in the S&P 500 at that return? This does include dividends. And like I said, this is about a 3.5% yield at today's price. If you want a bit more, some things to keep in mind, they do have about 2.6 billion in debt. 950 million of that is due in June 2024, so it is going to mature in June 2024. They do have about 700 million in cash on the books. They generate free cash flow. Will they roll that over? Will they pay it back? Who knows? It's at a 0.65% interest rate, which is ridiculous, which means they pay about a $6 million annual interest payment on that debt. Let's say they have to increase that to 5.5%, which is probably the going rate today. That's an additional 46 million in interest payments. I think they'll pay most of it off instead of rolling it over. But it's crazy how low the rates have been on debt in the last couple of years. Even their June 2051 debt is only at 3%. So they are able to actually get better rates on their debt due to their long-term history. Maybe they don't have to pay 5.5%, maybe 4.5%, but I mean 5.5%, given that risk-free rates are at 5%, is probably even a gift. So that's something to keep in mind. How will that impact their margins, their bottom line? What are they going to do with their debt? How much will they raise their dividend? In my mind, 7.9% just isn't enough for an individual stock. I'm putting in a target return here pre-dividend of about 10%, which might be a bit much. So that's about 13.5% after dividends. That gives you a fair value of about 24.56. So another 22% haircut off of today's price. Now, this is a historical dividend payer, dividend king. It should get a bit of leeway when it comes to that. It's a bit safer in downturns than some other companies. The stock price will still likely drop during a recession, but that's something to keep in mind in terms of their ability to continue to raise their dividend, pay their dividend, generate free cash flow, etc. So let's say you are more comfortable with a 6.5% pre-dividend return, which gets you closer to 10% after the dividend. Still about a $28.87 price point, which to me seems like at least a starting point that I would start considering this stock, start adding more money to this stock. So in my mind, I think if I'm setting up an alert on Fidelity for myself or whatever website I use, I'd probably be somewhere in the middle of that 24.50 range and 28.87 range. So maybe $26 or something like that. That's when I would strongly consider putting more money into Hormel. And the reason for that is, this is just not a grower. This company has not grown their free cash flow at all in the last couple of years. It's getting a free cash flow yield multiple of about 5%, which I think is about fair given their history, but they do have to show more growth. If they miss on these targets, if their margins continue to be at 6.8%, maybe even a 6% free cash flow yield is more warranted. And at that level, your fair value is closer to $21. So that's something to keep in mind. Is there further downside here? It really depends on how the market values these stocks. The risk-free rate is at 5.5%, 5% rather, based on the longer term rate. If it stays that way, or even if it goes up, these dividend stocks are going to be less and less attractive. That's something to keep in mind. That's why they're going down quite a bit. There's obviously cost pressure because of the new union contract. There's cost pressure because of inflation. How much can they raise their prices? How will their volume be impacted by these new weight loss drugs? How many people are going to take those? Are people going to eat less meat? All of that stuff is going to impact future returns. And for me, I would need a better return than just, maybe a market return or even lower if I'm expecting 10% from the market in the long run pre-inflation. So for me, it's at least 28.87, maybe even a bit lower than that if I want to get interested in purchasing this stock. Let me know what you guys think, if you are in the same boat or if you think it's a very attractive investment at this return. If 8% is enough for you, or if you think it can do better than 8%, if you think these growth assumptions and margin assumptions are a bit conservative, let me know in the comments down below. As always, do your own due diligence, guys. Don't make any investment decisions based on this spreadsheet. I will share the spreadsheet in the comments down below, so grab it there, hit file, make a copy if you want to play around with these assumptions. I always change this spreadsheet, so just don't, if you're coming to this video 3 months from now, for whatever reason, it's probably going to be inaccurate at that point because there's changes made and these numbers do not update automatically. So keep that in mind, and happy investing to you guys. I'm going to set a target here for myself of about 26 bucks and revisit it then, maybe start accumulating a position at that point. Like I said, I do own a few shares of Hormel in my Dividend Aristocrats portfolio, so full disclosure there. Do not plan to buy any more until it reaches a more attractive price target, because right now it just seems okay-ish. It doesn't seem like a really great deal. But let me know what you think. As always, like, subscribe, and bye.